And that means we are live here on YouTube. Tackle Trading's halftime report, August 19th, 2019. We've got Matt, we've got Cody, we've got Tim. And Matt, we're going to have a little half-hour show here. We got a meeting right at the top of the hour, so we got to get right down to business. S&P 500's back up. Moving averages are up here right above us. Obviously, a little W pattern, a little resistance, kind of moving into a consolidation. In my opinion, markets are neutral right now. What's your read?
Well, I think that's what we talked about all last week with the volatility. And it's been a wild ride the last few days, no doubt about that. But when you're looking at kind of identifying a trend versus, neutrality here, you got to kind of look at your pivot relationships. And you have a nice little downtrend as we saw, 2 weeks ago when it broke that support level right about 2970. Found support here at about 2820. Double bottom here late last week coming into Thursday, kind of finding that similar support level on the intraday right there at about 2820, 2815 as well. And then it's just kind of been a nice little, bullish type movement back up into resistance. And so you have to give it some degree of neutral rating here, Tim. And because of the volatility to the downside, the increasing volume, I do have a slightly negative slants on the market, but it's those bullish trades that are really kind of triggering this week so far.
Yeah, there's no doubt. In fact, go to the intraday chart, if you will, 5, 15, 30, doesn't really matter to me. We've basically gone straight up since Thursday. I mean, you had a double bottom, you had a breakout, you had a run into the end of the day on Thursday, through Friday's open, through today, through the overnight hours over on Sunday, Matt. It's been holding that run basically for about 2 days here, but now we're approaching some resistance zones. There's not a lot of news this week. There is Fed chatter. We've got FOMC minutes on Wednesday and stuff.
We also have Jackson Hole later on this week as well, where you're going to see some hints in interest rates and what they're going to be doing. I mean, most people still expect interest rate decreases coming into the back half of 2019. So that's going to be very, very interesting. I don't think we're going to break out before Wednesday. That's why I still have that neutral stance on the market. But you got to keep an eye. If you drop this down into the 1 hour chart, Tim, there's a very, very, very strong level of resistance that if you do break out at this level of resistance, you should see 3,000 again and possibly coming into those all-time highs around 3050. So keep an eye on 2940. It's a very, very strong level of resistance right there. You're approaching that level. You're only 17 points away, which is only a half a percentage point with the S&P 500 around 3,000. So you certainly could hit that intraday resistance level and break out of it this week, but it's not going to be on the backs of news because we just don't have a lot of it until Wednesday.
No, we do not. And even on Wednesday, I mean, the FOMC minutes is not usually a big market mover, Matt. So it's not like I'm expecting huge volatility from that.
No, but you're absolutely right. Usually it's not a big mover because they usually don't do anything. But given the fact that there was a lot of chatter, a lot of discussion, a lot of debate over that 0.5% decrease in the rate or 0.25% decrease, it's going to be interesting to read the minutes to kind of get an indication of where the Fed's mind really is. And the question that I think everybody has at this point regarding interest rate policy is whether or not that one interest rate decrease was just kind of a, hey, Trump, please stop yelling at me, or if that was kind of in the vein of thought that we're going to see an interest rate decreasing cycle. And Trump certainly did not stop on the railing of the Fed just last week. He's talking about how, China's not the issue, the Fed's the issue. So obviously Trump's not going to stop railing on Jay Powell. He wants his interest rate decreases. And so in that situation, this Wednesday is a little bit more important than usual Fed meetings, just given the fact that we need to see a little bit more indication on whether or not they are truly starting their interest rate decreasing cycle.
Yeah. S&P, NASDAQ, Russell, Dow, they all look very, very similar to me. Matt, give me a quick run through of all the different indexes, if you will, and see if there's any subtleties, any differences that you're seeing.
S&P and the Dow Jones are really looking identical to one another. I mean, they are just in step. They are dancing the same dance to the same tune. There is no differences here on the S&P and the Dow Jones. Maybe a slight subtle one. You're still underneath that 20-day moving average, whereas, the S&P 500 is kind of coming into that 20-day moving average. But again, the differences are extremely, extremely subtle when it comes to the S&P and the Dow Jones. Really dancing the same dance here. The NASDAQ showing a little bit of additional strength. As you can see, the pivot relationship never really came down to these levels, and you're showing a little bit more strength today coming into that level of resistance. And if you're looking at the NASDAQ as probably a potential breakout situation, focus on 77.90 in my opinion, right there, 77.90. If you break out of that 77.90, you should see some price appreciation coming out of that. But even the NASDAQ, I'd say subtly slightly more bullish than the S&P and the Dow Jones. But again, we're kind of splitting hairs there, to be perfectly honest with you. And then you have the Russell 2000, which is just stuck in neutrality ranges, and obviously has underperformed the market for the better half of the year. They had an amazing rally to kind of start the year, and if all you do is look at the percentage gains from the beginning of the year to currently, it's not lagging the broader market that bad. But a lot of that was on the backs of this historical V-shaped recovery. And remind you, the rut got beat up a lot harder than the other indexes did as well. So the V-shaped recovery at the first of the year was a little bit more, faster recovery than the other indexes. But over the last 5 months, it has just been stuck in that range. And the Russell 2000, very, very important level of support right there, 1460. That 1460 level over here, support, support, and then obviously massive support right there as well. If you break this down into the 3-year weekly chart, you can really kind of see the strength of that 1460 level. If that 1460 level is broken, obviously the market would show some volatility to the downside as well. But that's a very, very, very important level of support for the Russell 2000.
Yeah, it's been neutral most of the year. I think it's a really good point. Most of the gain actually happened right there in January when it popped off and rallied. I saw some data, across the Russell, the Dow, the NASDAQ, and the S&P today, and it's still up 10% year to date. The S&P and the Dow are around that 10, 12%. But the NASDAQ, we do talk about splitting hairs, but it's almost up 20%. So it has had notable strength here in 2019. There's no doubt about it. It's got a lot of upside.
The first 4 or 5 months, the NASDAQ was just a juggernaut. It was just an absolutely on a tear. And so when you're looking at it year to date, yeah, the NASDAQ has been obviously the best performing of the 4 major indexes. But when you're looking at the current pattern, I still see a little bit of strength in the NASDAQ versus some of the other indexes out there. But again, in this current pattern over the course of the last 2-3 weeks, you're really looking at something fairly similar. But Tim, that's what the market does when the market breaks support. It all trades in line with one another. And then as things start to kind of shake out as time passes, you start to see indexes kind of outperform, underperform. You see sectors do the exact same thing. And so what I anticipate happening over the next 2 to 3 weeks is some of the indexes gaining strength, some of the indexes showing weakness in comparison. But those sectors are really, the sectors are really going to be the key in looking at how those kind of separate themselves. And right now, take a sector like consumer staples, for example, just as a sector that kind of got beat up the same way the market did. But look at that recovery in this sector, consumer staples, really threatening that breakout of the all-time high at 61 in comparison to, say, the industrial sector, which is really kind of just stuck in neutrality.
Give me a quick look at FXI, if you will. Big news over the weekend was really around the trade war in China and all that kind of stuff. But that's really the news in the market. What now for 18 months? Since February of 2008.
News for the next 18 months. China's playing the long game.
Yeah, they're playing the long game. Obviously some positive chatter here over the weekend, Matt, but we're nowhere out of the woods here.
No, and not to get political here, but China's winning this war so far.
Yeah.
Every time the market volatility kicks in, Trump caves on certain things with the tariffs and the trade war. So China's playing that long game. They're playing a 100-year long game.
Bear retracement rally back into some old support, moving averages there. Obviously positive news headlines. Larry Kudlow was on some news shows over the weekend saying they had positive chats, and Trump has resumed talks and they're going to delay the tariffs. But I was actually pretty surprised, not necessarily surprised, but his rhetoric on what is that company that he doesn't want to do business with?
Huawei.
Yeah. He basically is coming out saying it's a national security threat. We're not backing down on this. That's not exactly the tone of positive news coming out of China, in my opinion. I think we're still a long ways away from this.
I do too. And I think I believe the Huawei discussion and decision is going to come fairly soon on whether or not they're going to allow certain business in America with Huawei. But there is some concern there, no doubt. Trump had dinner with, I believe, who was it? Tim Cook, Apple CEO, and they were discussing tariffs and how the tariffs could impact Apple, and the market took that as a little bit of a positive news as well. For me myself, I just want this tariff and trade war to get over with so we can focus on something else. And I think the trade war and the whipsaw action in the news cycle and the price action is really frustrating a lot of traders. And, we see these market conditions, but these market conditions do go away in time, and, we'll focus on something else. But the trade war is going to be here for the foreseeable future.
One of the major stocks in the news we got to take a peek at is Apple Computer. Tim Cook and the president actually had dinner together, I believe. Is that right, Cody? They sat down and broke bread. Is that right?
It broke some bread.
Yeah, I'm not really a big fan of one of the most powerful people in business meeting with the most powerful person in politics. Not a big fan of that one.
That concerns you for some reason?
I'm not a big fan of that.
Well, they've been doing it for a long time. I don't think that's a new, kind of act in that regard. But Tim Cook came out and basically was arguing, Matt, that Apple's going to be negatively affected by the tariffs and the trade wars more than their competitors are. Think about Samsung, think about some of their competitors, right? That they're not going to hit those.
Huawei is a competitor. Samsung's a competitor. Sony, so on and so forth. So, yeah, I mean, they are going to be impacted a little bit more, but obviously Tim Cook's going to take that stance, even if they don't get impacted.
Yeah.
I mean, I get it, Tim Cook. We all feel sorry for Apple and the $98 billion a quarter they sell. And, we're all, crying.
All that cash just sitting there.
Yeah, the 280 billion you have in some island, north of the UK. We feel really, really bad for Tim Cook and Apple, and we should make sure that we make decisions that only help Apple and them make $110 billion instead of $96 billion. So let me cry a river for Tim Cook.
Yeah. Well, the market's not crying a river for him. In fact, they actually gapped him out of here a little bit. It's one of the leaders in strength here today, 2.5%. Would you say a breakout up here above that gap out point on their earnings is a new entry point, Matt?
I would. The only difficult nature about this breakout here, Tim, you are running coming into the breakout. That's number one. So a little cautious, just given the fact that you've already ran from 193 all the way to 211 before that breakout. So that always gives me a little just caution. I don't like runners coming into breakouts and just expect it to run again. I would rather see this, and this is kind of give me what I want, the narcissistic nature of a trader here. But what I would love to see here is a little bit of consolidation. Let that kind of slow down a little bit, and then reset that trigger on the breakout. And that breakout is fairly strong. The second problem with the breakout on Apple is when you're looking left to the chart, it's not the same thing, because this was volatility around earnings. But where do you put that trigger? Is kind of the concern. Do you trigger above 212, where you currently have that level of resistance, or do you have this double top scenario at 218? And so I would say I personally would trigger above the 212 level, but only after some degree of consolidation.
Welcome out, Halftime Crew. If you're here on a daily basis, we love you. If you're here for the first time, welcome to our community, tackletrading.com. We are the premier online community for traders. And if you're new to our channel, click subscribe, click the up thumb, and get the word out there, the good word out here from Tackle Trading. Matt, let's run through the commodities and the currency markets here for a bit. At CL, obviously, there was some disturbing news, and I really just got the headline. There was an oil field in Saudi Arabia that had a drone strike from some Yemeni rebels. Is that right, Cody? Is that what you picked up as well?
Yeah, strike out there. Oil. They're saying oil's up on this, but if this was really a big impact, I think oil would be up more.
Yeah,
there's still.
That's the headline.
Yeah, it's the headline of why it's up. It's like, no, it's up just a neutral pattern. It's in that wedge. It's been in for forever.
You got to give news channels got to give some headline, and we see it constantly all the time. But if there was some big deal of disruption in the oil markets out of Saudi Arabia, I promise you, on a day where the market's up 1%, and then you have that coming into oil's breaking out of this range, and it just simply did not do that. And just to keep you in mind here, oil trades at an average of $2.12 a day, and it's only up like 86 cents. So it's not even trading it's trading like literally less than half the range right now. That's just a headline to give it some type of news.
I think you got new bearish triggers underneath those pivot points, Matt, from early last week, or mid last week, I should say. There's a couple of doji candles in there. I'm still leaning bearish. We've got that ranking on the commodity report at the negative 30-yard line. Crude oil is not just the only commodity that is showing lower potential here. Now, I know we're up here today, but we're below all those moving averages. It's Brent, it's gasoline, it's heating oil. They're all in bear retracements, Matt. Natural gas actually still as well. a lot of these are just fading and fading and fading. Out of all the commodity space, energy has not really outperformed. There's a lot of different ways to play it, but crude oil, natural gas, those are going to be two of the more liquid ones. Move on to gold, silver, some of the metals markets here, Matt. Gold is down, silver is down, but platinum, copper, and palladium are all up here today. In fact, palladium, you got to take a peek at when you're ready. Run through the metals markets real quick, if you would.
Hold on a sec. Yeah. So first and foremost, let's look at, excuse me. So first and foremost, Tim, let's take a look at the quick peek at the dollar, because that's going to impact most of the commodity space. Dollar a little bit overextended, not really coming into any degree of resistance here. We do have a slightly bullish rating on the dollar at the positive 30 level. We're seeing some triggers against some of the other currencies out there, but you are a little bit overextended, not a lot of activity happening on the dollar today. So just kind of just stuck in a little tiny range from an intraday perspective. If you can drop this down into a 30-minute chart, you just see that just neutrality there, just not a whole lot of price movement. And when you have the Fed minutes coming in on Wednesday and Jackson Hole coming in later on this week, I don't foresee the dollar doing a lot of crazy things this week in front of those type of news announcements. So taking a quick peek at gold, and we all trade gold. We all love gold. It's in every single one of our portfolios. And looking at gold here, just overextended. You're looking at a little bit of a high base type scenario forming with the trigger perhaps above that 1538, 1540 level. I don't care about that tick on that volatile trading day that we saw gold last week. So you're really looking at some degree of high base type situation. And a lot of times, what this reminds me of, Tim, is we're looking back here where you kind of just formed this little bit of neutrality as the dollar was rallying, and we kept talking about how it's playing defense and defense and defense and defense. And what happens a lot of times when you get overextended is these moving averages, especially the 9 EMA and a real type of vertical type trend, or the 20-day moving average here, you see it catch up to it, and then it makes the run again. And obviously, as this high base kind of extends over the course of the next couple of days, watch that 20-day moving average catch up to them, and let's see what it does, and perhaps it runs again. But I'm still extremely bullish on gold, and I'm going to be extremely bullish on gold until the central banks around the world kill every currency.
Yeah, I'm still bullish on the metals there as well. And obviously for different timelines, gold pulling back on a day-by-day basis is not going to concern me too much. The trend is still holding intact. You're going to have red and green candles on anything. Just think about the strength of that product just since May, Matt. It broke out at $1,300, $1,350, ran to over $1,500 an ounce. We're still sitting up here at $1,511. And it's been a juggernaut this year.
1,500 obviously is an important support level. It's a psychological number. 1,500 is one of those extremely psychological whole numbers that's going to play defense and going to act as a support level for it. And that's what you've kind of seen here, and now even on today, as gold was coming down, kind of kissed off that 1501, 1502 level before it recovered another 10 points. So easy stop losses here under 1500 if anybody does look at a trigger. But the way we approach gold is more from a position perspective, an investment perspective, than it is a swing trading or day trading vehicle. You certainly can swing trade, especially in a trend like this. But personally, I prefer gold from a position or an investment perspective.
Quick peek at Bitcoin, if you will. Talking about currencies, talking about cryptocurrencies now holding, Matt. So kind of the longer it holds, though, the more concerned I have about the pattern, because now you're moving into a compression pattern. You're riding the moving average. What you're reading in the technicals here?
Technicals here is real neutrality here over the course of the last 2 months, very volatile neutrality over the course of the last 2 months, but there's no trade here, right? I mean, we've said this many, many times. You're either day trading. This is either a day trading vehicle or it's a holder vehicle. And I don't see any swing trades or position trades that have really set up. I mean, maybe a trigger above 14,000 on a swing trade, but I mean, think about that. You're waiting 30% before you trigger on something. It's just that's a very, very difficult trading vehicle, to be honest with you.
Yeah, I agree. It's a Monday, and one thing we do each and every Monday, Matt, is we look at all the different sectors. And by the way, just quick programming note today, Matt and I, we got to go in 10 minutes, so we're going to be efficient with this. And Matt, same thing that any trader has to deal with. When you only got a half an hour to run through your routine, you got to rely on your process. There's no question about it. Give me a quick read on all the sectors. Give us the rankings. Give us a quick rundown here, Matt.
Well, first and foremost, we always start with ranking on the S&P 500. And when we were sitting in the Scout Report meeting on Friday, we kind of saw a little bit of, downward movement in price coming in on Thursday. on Thursday, and then it kind of found support here. We put it at the negative 45, but I mean, honestly, negative 45, 50, positive 45, that's all really kind of in the same range there. Not a lot of buys. We have a neutral rating on the S&P 500, and we've had a neutral rating on the S&P for, probably the last three tackle newsletters that we put out there in the last 3 weeks. And until we start reclaiming some degree of trend here, and we could reclaim a trend if we do see a breakout this week, but until we see that, you really got to start with everything kind of set at neutral. The dollar's rating at this point, but we did upgrade the dollar coming into this week. We liked what we saw last week coming into the dollar, or the performance of the dollar last week. We did upgrade that to a slightly bullish parameter at positive 30. Let's start with the aggressive sectors very quickly, see if we can look for any triggers or upgrades, downgrades here. Consumer discretionary looking very similar to that of the S&P 500. We did upgrade consumer discretionary just slightly. We did like the double bottom a little bit more, upward movement in price. And so we upgraded it into what I call the coward rating. And the coward rating is when we put some at the 50-yard mark, when we're like, all right, are we left of center? Are we right of center? Yeah, let's just take the coward rating there. And that is right there at the positive 50 level. And we liked some of the stocks we were looking at in the consumer discretionary sector as well. The next one, industrials here. Industrials, we downgraded into the negative 40 territory. So when you're looking at industrials in a negative 40, that is not a bearish rating, but it's a certain anticipation of a bearish rating. And that would be upgraded given what we saw here on the response on the overnight action. As you can see, it gaps up here in the market. When you're looking at the S&P 500, there's no gap here. That's because it's in the futures market, and the futures market opens up at 5 p.m. Eastern Standard Time on Sunday night. So you see this kind of price movement move up here, and you're like, well, I can catch that, at the market open. And it's like, no, that's not how it works. That's a gapping situation because this is an ETF that trades during the actual stock market hours. So it would get upgraded, negative 40 territory. And the reason we did, Tim, is we saw that breakdown out of that support level, and that was not something technology or consumer discretionary or even the S&P 500 did. So we downgraded it. That would be upgraded probably into the 50 territory now that we've seen the Sunday cash open. Looking at technology, we did downgrade technology down into the positive 35 level. And so we are seeing a little bit of strength. We're still bullish on the technology sector. When we were looking at the indexes, it is the number one index out there threatening a breakout. And that's what you're seeing here. And it's kind of hard to see the price action because the moving averages are kind of stopping it. But that's a nice little hammer candle approaching a breakout. So definitely look at technology stocks if we do see some price appreciation this week. Looking at the communication sector here, Tim, communication looking very similar to the broad market. We kept it at the same negative 45-yard marker. No upgrade, downgrade for the communication sector this week. And then in your energy and your basic materials space, basic materials has a negative 40 rating, very similar to what we were seeing in industrials. It kind of violated that support level. So we gave that negative 40 rating. It would have kept the same rating if we saw the Sunday open. But obviously when you're ranking things on a Friday, you don't have the benefit of seeing the Sunday futures market open. So we did downgrade it. I would still put it into neutrality, and it is underperforming the market. So negative 40 makes sense when you have a negative 45 on the S&P. And then the worst performing sector out there, year to date, and just from a trend pattern perspective, is definitely energy. We kept energy at the negative 20-yard marker, a little overextended coming into the breakdown. It might retrace back into this 20-day moving average, but those stocks are so garbage out there in the energy space. Maybe a little bottom picking going on, but nothing that I would look at from a bullish perspective. Still a very negative sector. Looking at your defensive sectors, Tim, some of your best performing sectors, even with the market going up today, look at utilities here. Utilities with a strong breakout, despite the market going up, threatening those resistance levels. Usually we see utilities underperform that. Utilities said, hold my beer, watch this, let me break out and run here. So keep an eye on that on the utility space. We did.
Is PCG still in XLU?
I think they kicked it out.
Did they kick it out? Because PCG had news today. They're down like 30% or something like that.
Oh, we haven't looked at PCG forever.
So long, but a judge came out and
color be surprised.
said they're still liable for their stuff and they cannot file bankruptcy. Sorry, the utilities thing made me think of the news there, and it's just dropping like crazy. But another reminder of that stock, Matt. Well, that was one of our most talked about last year for sure.
Look at that bad boy. Yeah, that was on the no-fly zone. Never touch, never look at again on PCG. No doubt about that. Looking at the utility space, though, utilities is absolutely doing something pretty good out there in this space right now. Look at that breakout. Keep an eye on the utility stocks. The other defensive sector here, very defensive. We talked about these last week. XLRE, high dividend payers, broke out on Friday, continued with a hammer candle today. And they're underperforming the broad market from a price action perspective today. But that's really beneficial when you saw the market go up, and yet real estate and utilities held firm on their breakout. So keep an eye on real estate as well. The sector that I've liked year to date the most consistent sector, in my opinion, would be consumer staples. Gave that a positive upgrade as well. So the three sectors that had positive upgrades. Well, there's four sectors that did. Discretionary went up to positive 50, but the three that got upgraded into the bullish territory: utilities, real estate, consumer staples. Your three safe haven sectors out there, and consumer staples making a run into that breakout. Probably a little bit overextended. Wait for some degree of consolidation there, but I certainly like that sector in terms of consumer staples. And then in your last two sectors here, financial, looking very similar to industrial here, looking very similar to basic materials as well, as it broke its support level last week, forming a little bit of a bearish retracement. Going to be interesting to what's happening on the bank stocks. I still got a slightly bearish rating on there, right there at -40. And then on healthcare here, Tim, healthcare showing a little bit of strength here today coming into the breakout channel. If we do have a -40 rating on it, but I would upgrade that into most likely somewhere around the 50 level based on the price action we're seeing here today.
Oh my, the markets are up. They're up across the board. It's a risk on atmosphere that we are in right now, Matt. Jackson Hole Symposium this week from the Fed. What do you expect out of Jerome Powell? Just last thoughts here, because that's going to be dominating our conversations throughout the week.
I think the elitists are going to have some nice salmon.
I'd like to go to this economic symposium at some point. That'd be kind of cool. Would you sit down and listen to him, Matt?
Would I sit down and listen? Would I go to one of those meetings if I couldn't talk?
Yeah.
Of course I would.
Yeah, I would too.
Of course I would.
I would go and take notes and listen and see what the most powerful bankers in the world have to say about modern monetary theory.
And then I would come on the halftime report and I would rip them.
That's right. Oh, that's exactly right. Well, we're going to Jackson, the old Johnny Cash song. I think of that every time they have this Jackson Hole Symposium. There's no doubt about it.
When did they start doing Jackson Hole? Was it 10 years ago?
God, they've been doing it for a long time. It's probably longer than that, actually. I mean, it's a pretty, big annual event. Obviously, they got big speakers and big expectations. Is the market spoiled enough to where they're going to want to hear Powell come out and even talk about lowering rates aggressively? Do they need something from him here, do you think?
I don't know. I think proceeding Jackson Hole is going to be important. Obviously, reading those minutes on Wednesday to get an indication on interest rates coming into the back half of 19. I think that's going to give us an indication. Jackson Hole, yeah, you're going to get some indications out of Jackson Hole, but a lot of that is just theory based, Tim. They bring those speakers in to give these theories, and then they practice their theories by using us consumers in America as their guinea pigs.
Yeah.
Much appreciated, Fed.
All right, guys, we're going to wrap this one up at 30 minutes in. We'll be back tomorrow with the halftime report. I just dropped a link in the chat for the events for this week's Tackle Trading members. Tonight, we have onboarding. So if you're a new member of Tackle Trading, make sure you attend that webinar, 8:30 Eastern. Coaches Show tomorrow, the Step System Mastermind Group on Wednesday, Cash Flow Club on Thursday, Daily Traders Lounges, and of course, Matt, our halftime report we do each and every day. Good, efficient job today, guys. We'll be back tomorrow. We are out on a Monday.